Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. Once again today, we're looking at gains across the board. Some of the momentum from last week carrying in to at least the start of this week's trading action. You're looking at the Dow up 81 points, the Nasdaq, the leader in today's action, up just around 0.9% and nearly 1% gain. Taking a look at the sector movement here, financials and technology leading today's gains. Akiko.
Well, SEC Chairman Gary Gensler making headlines on AI today, calling the technology transformative while also warning of the risks it might pose on capital markets. Yahoo Finance's Jennifer Schomburger sat down with Gensler for an exclusive interview to discuss his views on regulating the space. Take a listen.
Chair Gensler, thank you so much for sitting down with me. It's great to see you.
Great to see you again, Jennifer.
So you sent a warning shot today on AI. Do you think this could be the next financial crisis absent proper protections in place?
I think that it's quite possible that a financial crisis of the late 2020s or the 2030s, the after-action report will say, oh, we didn't know that everybody was relying on the same base or foundation model for their mortgage information or their stock market information. And these base or foundation models are called that for a reason. And you're going to have a lot of applications built on top of them. There's macroeconomic reasons why that will happen. The models are hard to explain. They're quite complex. And I think we really do need a serious conversation amongst and between financial regulators around the globe, because it's not about any one model or any one market, but it's really the reliance on these models in our capital markets.
How immediate is this threat?
Well, AI is already very much embedded in our capital markets. Large asset managers are using it, possibly even to listen to this interview here and take the sentiment and does the stock market go up or down based upon how you ask your questions or your smile, but possibly the words I use and choose. And it's being built into robo-advisors and elsewhere. But if you can take all the inputs of the market pricing and tie that into the sentiment analysis following chief executive officers of companies, you can start to see patterns and trade more effectively. But it's also possible that we end up with dependencies on a base model and end up with, in essence, a monoculture, that the markets all go in one way based upon that base model.
You mentioned financial markets are already using this technology. I want to ask you specifically about generative AI, the rise of ChatGPT, Google's Bard, and layering that into financial services.
Baidu's Ernie in China.
Right. You just gave a speech on that. These machines have shown a proclivity to start learning things on their own that they haven't been taught. And companies don't really know how they're doing that. And they've also shown the propensity to fabricate information and pass it off as truth. Correct. So, to use a terminology of the industry. So what is the risk that these machines start embedding biases, fabricated information into making recommendations and ultimately decisions? What's the risk that people's personal financial information all of a sudden gets disclosed publicly? How do we guard against this, Chair Gensler?
So I think these are important considerations, that the models might give recommendations or just narrowly influence our behavior as individuals, so-called narrowcasting to us. Advice or communications or products or pricing that extracts more profit for them out of our pocket. So that's one issue. You raised the question about bias. If the underlying data that's being collected reflects the biases already in our society, then the actual algorithms will reflect that bias as well. And then you mentioned deception. all of these the SEC is looking at. On the last, fraud is fraud. If a bad actor uses artificial intelligence to try to deceive the public, we're authorized but also mandated by Congress to go after that. But it's not without its challenges. These are sometimes hard to explain models. If there's biases, other parts of the financial sector, like the Consumer Financial Protection Bureau, looks at that. We have a role in that as well. So I think these are rapidly changing times, and there's very good questions.
So you mentioned the challenges, and I know you have asked SEC staff to provide recommendations about the challenges of regulating artificial intelligence. What has staff reported back to you? What have you found? What are the biggest gaps?
So let me cover three. The staff is working on recommendations with regard to conflicts that might arise when an investment advisor or broker-dealer is using artificial intelligence or other predictive data analytics. We're technology neutral, but if they're using an algorithm to communicate with us, to engage with us, and if they're considering their own profits or revenues, their own interest. In essence, are they putting the investor's interest ahead of the advisor's interest or the other way around? And we're going to take a look at the recommendations from staff on that. Secondly, I mentioned fraud and deception. That's just active. And of course, if the listening public thinks they've been defrauded, there's tips, complaints, and referrals at the SEC. And then thirdly, as I mentioned earlier, with regard to financial stability, I think that's really more a conversation amongst the financial regulators. That's an important conversation as to how do we guard against the crisis of 2027 or 2032 that might arise out of so much of finance relying on one or two base models that takes us off in the wrong direction.
Do you think that you're going to need to write specialized rules to govern AI in addition to applying securities laws already on the books?
At least at the Securities and Exchange Commission, our approach is looking at the outcomes of the use of technology. We're technology neutral. We at the SEC don't regulate calculus. Now, maybe some of your listeners would wish us, we don't. And we at the SEC wouldn't propose that we regulate any individual technology, but we look at the outcomes of its use. But in terms of our mission, protecting investors and facilitating those who want to raise capital and the markets in the middle, the increased use of AI is on our mind in ensuring that we achieve the rules in place and maybe augment them with additional rules like we're considering in this conflict area.
So you said augment, so maybe a little bit of extra building on in terms of rules to make sure that investors are protected when it comes to AI.
Absolutely, but it's really technology neutral.
Right.
It's just that using predictive data analytics raises new challenges for what's time-tested policy about ensuring that an investment advisor puts your interest ahead of theirs. Well, now you have an algorithm that might actually, by the math, possibly be considering the investment advisor's profits or revenues or other interests, and then to guard against those conflicts.
Switching gears, I want to ask you about crypto.
There you go, Jennifer.
You didn't think I was going to let you off the hook, Chair Gensler, did you? All right, so last week we got a major ruling from the Southern District of New York on Ripple. How does this ruling change your approach, if at all, your abilities when it comes to regulating crypto and specifically crypto exchanges?
Look, our approach has been the same. It's about protecting investors, facilitating those who want to raise money, and the markets in the middle. And that's true whether it's in other parts of the securities markets or the parts of the crypto markets that are securities. And in terms of the decision, we're still taking a look at it. We're pleased with how the courts addressed itself to that a token for institutional investors is a security, how they address themselves to fair notice, disappointed in other aspect about retail investors, but we're still taking a look at that and considering it.
Coinbase is already relisting Ripple. A lot of these crypto exchanges feel like this was a real win for them, that the tokens that they list on their exchanges are not securities based on this ruling. So what do you say to them? Are you concerned about potential precedent that this could set, especially for other charges that the SEC has brought against other crypto exchanges?
Look, again, Jennifer, you're asking good questions, but there's ongoing litigation with regard to a number of these crypto platforms, and these crypto platforms are commingling a number of services that you've seen on these crypto platforms where they could well be trading against their customers, bundling up a bunch of services that we would not allow in any other parts of our capital markets. So the investing public comes first. That's how our securities laws were first written. Companies raising money in the markets as well, and really protecting them and protecting the integrity of the markets. But I'm not able to go into any ongoing enforcement matters.
So it sounds like it's still sort of an open question. I wonder, there's been some confusion that's been generated from this. Does it make you reconsider writing customized rules for crypto?
Again, it's too early. This was like 3 business days ago. But I would note, the agency has rules on the books right now. It's about full, fair, and truthful disclosure if you're raising money from the public and the public's anticipating profit based on the efforts of others. That's why Roosevelt called it the Truth in Securities Act. There's rules on the books about what it means to be a securities exchange, what it means to be a broker, an investment advisor. There are rules on the books. We've also put forward or even adopted rules with regard to broker-dealers in this space called special purpose broker-dealers. We put forward proposals with regard to the safeguarding of those assets, or even exchanges in what's called the decentralized finance space. So we've done some of that, but again, we'll continue to consider.
Republicans on the House Financial Services Committee have put forth a discussion draft on a framework to regulate crypto. And within that proposal, they're looking at laying out guidelines that would direct which firms would need to register with the SEC. They would have you write customized rules. And I think the biggest point is that they would have a decentralization test to decipher whether a token is a security, a commodity, or both. I'm curious what you think about these principles, especially the decentralization test. Jennifer,
we are asked by members of Congress, both the House and the Senate, on a regular basis to look at their various pieces of legislation, and we generally give them our feedback directly rather than through the interviews on the
So decentralization, good idea, bad idea in general?
Yeah, I'm going to, again, I'm going to save our comments on any draft legislation for our members that are asking us directly. But this field, the crypto field, Satoshi Nakamoto writes an 8-page paper, and it was at the core of that paper was this concept of moving value on the internet without a central intermediary, a central bank or a commercial bank, but moving value on the internet. Whomever Satoshi was. This field is actually quite centralized. Around each of the tokens, there tends to be a group of entrepreneurs, and you can find a website and you can look, and there's a maybe a Twitter account and somebody that might even have a name of a CEO or CTO, Chief Technology Officer. Around the platforms, they're quite centralized as well. So this is a field that is not immune to the economics of finance. Since in antiquity, finance tends towards some centralization, and that's what we've seen happen in the crypto field as well.
The first half of this year was marked by more than a dozen enforcement actions by the SEC when it comes to the crypto space. Should we expect more of the same in the second half of the year? What can we expect from the SEC when it comes to regulating crypto in the second half of the year?
I think over the last 6 years, we at the SEC have brought, settled, or litigated somewhere close to 150 actions in the crypto field. So I don't know what the next 6 months will hold, and I'm not at liberty to speak about any one enforcement action. But we're really focused on protecting the integrity of the markets, the investing public, capital formation, as I said earlier, and trying to bring greater compliance within this field.
Before we wrap up, Senator Elizabeth Warren sent you a letter today.
She did?
She did. She says, oh, this is news to you.
As I was preparing for giving a talk at the National Press Club and meeting with you.
Yes, yes. And she says she would like you to investigate Tesla for, quote, possible conflicts of interest, misappropriation of corporate assets, and other negative impacts on Tesla shareholders related to Elon Musk's takeover. Are you prepared to entertain this?
Jennifer, I thank you for bringing this to my attention. But again, we're not able to speak to any potential investigation or ongoing investigation, whether we have one or not, regardless of whom might be asked about.
All right. Well, Chair Gensler, we'll have to leave it there. Thank you so much, as always, for your insight. It was great to see you. Look forward to seeing you soon.
Thank you, Jennifer.
Our Jennifer Schomburger there, speaking to SEC Chair Gary Gensler exclusively after that big talk, Shauna, that he gave at the National Press Club. A number of interesting things to come out of this, but let's talk about AI first, because it's been interesting to hear his comments, given that this is something he looked into at MIT. This is not his first foray into AI. He's written a paper on this before. The big concern here, he talked about having a base model that many would join in on. In other words, if you have a limited number of base models, lack of competition, that could lead to financial instability. I want to point to one thing he said specifically in that speech he gave today. He said AI may heighten financial fragility as it could promote herding with individual actors making similar decisions because they're getting the same signal from a base model. And that's something you could argue that has been a threat even before generative AI came into the picture.
Yeah, and this is something you could argue really when it comes to passive investing, what has really taken place in the past, kind of that herd-like mentality in terms of the options that are available to investors. So this isn't the first time we're seeing something like this. We also know robo-advisors, at least right now, are using AI in terms of their strategy. That's how it's being implemented for wealth managers today. But what also stuck out to me is kind of going along with this herd mentality, what he wants to address, was also what he said just about the concerted effort, the global concerted effort that he would like to see from across the world in terms of what exactly needs to be addressed. So saying that we really need a cooperation from outside the United States to get a better handle on AI and the threat potentially, at least in the SEC's eyes, that it could pose here to investors, to the greater financial markets down the road. And you mentioned the fact that he has been tracking AI for quite some time, and he has said he hasn't shied away from it in the past, calling it the most transformative technology of our time. So he raised a number of good issues, but the question is, how exactly can the SEC, how will the SEC and other regulators across the globe go about trying to regulate this market when there are still so many unanswered questions?
Yeah, in many ways, they have seen the early days of the AI, to your point, Shauna, because how the technology has already been implemented in financial markets. So it's really a good gauge of where things are likely to go. And good insight there in that interview with Jen talking about how he's viewing the potential for regulation. One more thing I just want to note here on crypto. He talks specifically about using the regulation that's already on the book. Nothing new. I mean, he's talked about this before, but that again points to this divide we still see between the SEC and somebody like the CFTC, who's called for new regulation as he sees what's on the books as sufficient enough.
Yeah, and I think that this is an issue that is going to play out for quite some time. We are at least taking some steps in terms of what maybe that regulation could look like, but there's still a lot of unanswered questions. And we're talking to the fact that he's still looking at and assessing some of the opinions out there, especially when it comes to this Ripple ruling that we just got last week from the New York judge saying that, in fact, when it was sold to retail investors on exchanges, it wasn't a security. So I think there's just lots of questions about exactly what has already taken place within the crypto market and whose responsibility it will be and should be going forward in order to get that regulation. But a great interview there by our colleague Jen Schomburger with SEC Chair Gary Gensler. We want to take a quick check of the markets here. 40 minutes to go until the close of the trading day. This market check sponsored by Tasty's Trade. We're still looking at gains across the board. The Dow up a little bit more here, up just around 140 points. Nasdaq up about 1%. Let's also take a look at the VIX, the fear gauge index, which is under pretty decent amount of pressure last week, up just a bit today, up about 1%, right around 1350. All right, we are just getting started here on Yahoo Finance Live. Coming up, the road ahead for Tesla, the EV giant announcing its long-awaited Cybertruck hit a big milestone. We've got the details for you. And a strong start to bank earnings showing that the biggest names in the sector are bouncing back from the crisis. But how will regional banks fare this quarter? We'll get analyst insight on what he's seeing for this sector. Don't go anywhere. Shares of Ford trading lower today, off just about 5.5% after slashing the price of its F-150 Lightning. Yahoo Finance's Praz Subramanian has that story for us. And Praz, certainly looks like Ford feeling the pressure from all the price slashing that we've seen going on from EV makers this year.
Yeah, these are some big cuts for the F-150 Lightning. Almost $10,000 there for the base Pro model, but also extending from 9 to 16% in terms of price cuts across different trims. So those are some big movements there. Ford said that moderating materials costs, improving scale at their Detroit Rouge factory have helped with F-150 production. But we've been seeing reports about inventories of new cars rising, inventories of EVs in particular rising are getting pretty high. So I think this is something that Ford's feeling the pressure, and even Jim Farley said this to us back in May, that he sees EV prices coming down. And these are some big significant moves for the F-150 Lightning, which is presumably still has a decent waiting list.
And Praz, a potential competitor. And the moment a lot of Tesla investors have been waiting for, that photo that was tweeted out on the Tesla account. The Cybertruck finally at least built for the first time.
Yeah, I don't think it was surprise perhaps that Ford announced these price cuts on the same day or over the same weekend that, with Tesla announcing that the Cybertruck rolled off the assembly line there in Giga Austin. Now, we don't know if this is a pre-verification build or an actual car that will go to a customer, but nonetheless, seems like Tesla is on track here to begin Cybertruck production, at least in a limited capacity in Q3, and potentially have that customer delivery event that Elon Musk had said last quarter happening in the end of Q3 as well. So that's good news for Tesla, seeing the stock moving up higher here at the highest level since fall of 2022, I'm sorry. So that's good news for Tesla, but also, talking about Ford, there's possibility that the Cybertruck will be coming in the same price range as some of the XLT or Lariat trim levels of the Lightning EV. So that's why there's some concern there on the Ford side too.
Right. Everybody waiting to see what that delivery event's going to look like. Praz Subramanian, thanks so much for that. From economic uncertainty to geopolitical tensions, our next guest says business leaders are increasingly navigating the new abnormal. Now, former Dow CEO Andrew Liveris is drawing on his leadership experience to guide companies along in a new book, Leading Through Disruption. He's standing by with our very own Brian Sazi for a special interview. Brian.
Thanks so much, Akiko. Andrew, thanks for joining Yahoo Finance in studio. New book out. Congrats on that. One of the most disruptive things I think a lot of leaders are seeing in this market today is China, the recovery or lack thereof. You hear Treasury Secretary Janet Yellen saying that could spill over, that slowdown could spill over into the rest of the world. How do you see it as someone that has operated in this country for decades?
Yeah, I definitely think, Brian, thanks for having me. The book has a whole chapter on geopolitical volatility and uncertainties. And I make a big statement in the book based on my China participation over 3 decades, that the moment that China's toggled over to a new China has arrived, and that business needs to embrace that very, very new paradigm, which is China is always been for itself. The Hermit Kingdom has risen, and now it definitely is for itself. And so as a CEO of a global company, one has to make a decision. Am I a global company that happens to be based in the US, and therefore I will full on participate in this new China? Or am I an American company that has global subsidiaries and presence, and do I become a transactional company in China? That moment has arrived.
What's the right play if you're a leader?
Yeah, there's no right play. So it really comes down to what in essence is technological advantage and innovation. The American innovation engine is alive and well, as we heard in that previous segment. Having said that, we lagged dramatically in the transition to EVs, the transition to renewables, the transition to all sorts of ways to get alternative energy. As an example, we lagged in many things that mattered to the American industrial machine. My first book talked about that, Make It in America. So this China not only can make, it can invent and innovate. And so what you've got to decide is, how does my technology stack up against the Chinese technology? And then do I go in there as a full partner and stand to lose it, which you will? So then how do I actually participate in that amazing emerging market? My answer in the book, diversify like crazy. Figure out the new regional alliance structures, and there's plenty of those. Quad, AUKUS, the new India, Middle East, where I'm getting to play quite a lot, and go and have big strategies there. So it's not just relying on a China strategy.
You're such a unique leader because of, in addition to having all that experience in China, you're also on that Lucid board and know the EV industry very well. I mean, do you see the U.S. as behind China in that race?
Look, I would have said a definite yes 5 years ago. It's no longer a strong Yes, that we're behind. We're catching, and companies like Lucid have put a significant amount of money, risk capital. Of course, Tesla set the pace, but the development of longer range, shorter charging times, and then the comfort level of absolutely the price point and making money at that price point, the big OEMs have taken it on, and they're accelerating. We saw Ford, and Lightning, and GM, and all the big US OEMs are starting to bring technology to the party. I'd say in 5 years, we'll catch.
Do you view the Cybertruck as a disruptive event for a company like Lucid?
Yeah, well, Lucid has got its own plans on SUVs, and we had our car on the road not all that long ago, and it's going to be an incredible SUV, and one that makes the regular sedan, which is not hardly a regular sedan. The Lucid Pure and the Lucid Dream are a phenomenal car with great technology. Look, we're not deliberately targeting Tesla. I'd like to think that there's enough market, total available market for all of us. As ICEs fade away, the EV market will continue to be big and explode. You just got to scale and get the cash flow to work.
And switching over to the US here, you mentioned in the book you have worked with 4 US presidents.
Yes.
What grade would you give this administration in terms of growing the US economy?
Look, my first book and now the second book was all about how to get business and government to work together in a partnership model, which is not a market-based model, actually. It's an industrial policy-based model. In other words, you need a government and a business community that's comfortable with each other, not regulator and regulatee. The previous segment talked about regulating the digital sector and regulating AI. I am for that. Because what business needs is educated government people, leaders, politicians, bureaucrats, agencies, working with the subject matter experts in business to develop the right regs for the future.
Are they not working with business?
Well, most administrations, especially from the right of the aisle, are hands-off. They think the market will work it all out. The market doesn't all work it all out. The market absolutely totally needs rules of the road. And so therefore this administration, 3 landmark bills, and I was involved with one of them, the infrastructure bill, absolutely totally setting the rules of the road for this next century. So in that context, high marks. Working with business, they're suspicious of big business and are getting better, but I'd still say it's still an area to work on.
Lastly, before we let you go, you talk a lot in the book about succession. Now, the world of investing is watching what's happening at Disney with a boomerang CEO, Bob Iger, coming back. You led a succession plan at Dow that appears to be working well. What is he not getting?
Yeah, I know Bob very well, and Disney's a great company. And these great American storied enterprises, they have got succession well over the decades. You know, I was the 11th CEO, Jim Fidling's the 12th, but the first 6 were family CEOs. So if you think about that toggle, going from founder CEO to absolutely professional CEO, that's a hard succession. But the succession plans that work, and General Electric, Procter & Gamble, IBM, I'm on the board of IBM, where they get it right is they work on it immediately. And I talk about that in the book, as you say, a lot. We started working in succession at Dow the day I got appointed. And Jim just happened to be the graduate right at the right moment in time when I was ready to leave. The board was ready for me to retire, and I just did the Dow DuPont deal, and it was the right moment to pass on to the next CEO. And I think that timing has to be exquisite, but you've got to have options. And especially in this volatile era, this new abnormal, this new paradigm where leadership vacuum exists, the new business-driven CEO has to have an external presence with government to earn the license to operate from society. In the book, I talk about how to do that, and I absolutely totally think it's a playbook for this century, not when I got to be CEO.
Indeed, it is a must-read. Leading through disruption, Andrew Livers, good to see you. Thanks for making time for Yahoo Finance.
Nice to be with you, Brian. Thank you very much.
Kiko, back to you.
Okay, Brian Sazi, thanks so much for that, and our thanks to Andrew Livers as well. Well, coming up, Santa Claus is coming early for investors, according to our next guest, and she says it's Christmas in July for stocks. But she also warns the Fed may play Scrooge on the broader rally. We'll discuss on the other side.
Stocks pushing higher amid optimism that the Fed is getting a better handle on inflation. The move to the upside today, adding to last week's gains as investors prepare for a very busy week of earnings. Let's break it all down and what we can expect. For that, we want to bring in Linda Dissel, Federated Hermes Senior Equity Strategist. Linda, it's great to see you. So earnings is certainly going to be the next big test here for the markets. We've heard from some of the big banks. Bank of America was out with a note this morning saying that of those that reported, a small number, but 77% have beat so far. Is that going to be similar here as we look out to the rest of earnings season?
Well, good afternoon. Thanks for having me today. And, earnings season is probably one of the better catalysts for where the next moves in the market will be. And it's really a question mark. You can extrapolate from early times. And as you suggested, we're early into this season. We'll be hearing from more banks this week. We'll be hearing from some other big names out there, but really we have to wait till we get into the meat of it. And what we want to hear is companies' outlooks going forward, which has been mixed. Small business optimism has been, well below the long-term averages. They still worry about an inflationary situation, but their inflation levels are definitely coming off the boil here. So we'll be looking for that. Right now, it looks like we'll see a mild decline, much as what we saw in the first quarter. And what we're really interested in at Federated Hermes is the back half of this year, where we think you might really see concerns in terms of earnings.
What concerns specifically?
Well, because what's been happening here is you've been seeing throughout the economy a disinflationary environment, which is good. It's good for consumers, but you've not seen it in wages. In fact, the Atlanta Fed wage tracker, which looks at skill by skill set, kind of apples to apples, shows us that you're still getting 5% year over year wage hikes. Well, if a company's expenses are still going up, to the tune of 5% or so, but their inflation overall and the inflation that we see comes down, that can hurt their top line, while margins can get hurt, and that can start to really bite into their earnings on a going forward basis. It's really more about disinflation not yet hitting the most core of inflationary problems, which is the wage situation. Of course, that's what the Fed's watching as well, as they're expected to raise again here in July.
Yeah, certainly. We'll talk a little bit more about that in just a second. But getting back to earnings and some of the themes that we are going to see this earnings season, investors are also closely watching for any commentary around the consumer. We did get some of that from the big banks last week. But are you expecting to see a further deterioration just in terms of spending power and what consumers are able and willing to spend on?
Well, the consumer, we're a consumer-led economy. That's an all-important question. And to the extent our unemployment situation is strong, it remains very, very strong. And even consumer sentiment looks pretty good, especially for their current situation. Anybody who goes to an airport knows that there's no recession at the moment. There's a lot of demand out there. And if I have money in my pocket, if I have a job and I've not lost it, and if my friends haven't lost their jobs yet, then I'm not going to worry about anything in the future. I'm going to go out there and spend. And so, so that is what we continue to see here. We'll be looking at retail sales tomorrow. It looks to be, potentially up mildly so. But I saw a very interesting statistic recently, because we can worry if we'd like about the student loan payments coming due finally, starting in August, September. People who have loans, some research I've read just recently, who have loans out there, have bank account holdings about 40% higher than what they were in January of 2020. So they're really in better shape right now and can't afford to pay those loans. And their balances are equal to those who don't have a debt. So I don't know if maybe the concerns about a declining consumer are premature here.
Let's talk about where things stand, specifically on inflation, because we have seen a broad pullback, but core inflation still very sticky. Consumer prices rose at the slowest pace since March 2021. We saw inflation slowing further, signs of cooling in June. We've got the Fed meeting next week. The expectation is that they will, in fact, raise rates. But the question is, what do they do after that meeting? What do you expect?
Right. And if you noticed, we as market watchers, pretty much consensus has said this will be the last one for a while now. And it's not been the last one. They started at zero, so they had to raise a lot really to get even restrictive here. They say that they're focused on the labor cost, and the labor costs are definitely not under control well enough yet. And they say they're very, very keen on getting a 2% inflation rate. I believe that Jerome Powell did a press conference where he said he said 2% maybe 14 times. He says it as if he means it. We should take him at his word. And so that being the case, the Fed is where any bull needs to wonder if the Fed is going to throw us into a recession, as it has mostly in prior tightening cycles. That's something to concern ourselves about, maybe late this year, maybe into early next year.
Linda, do you think we will see a recession?
We're calling for a mild recession at Federated Hermes because what we see today is a consumer that, as we said, is flush. We can see a recession that comes with a slowing economy by way of corporations, companies having problems, as we discussed earlier in our talk here, but a consumer that's really much stronger, much more resilient is the word that I keep reading, and I think that's true. And particularly when you consider that 80% or 75%, I should say, of the investable monies out there is held by people age 55 and older. That aging boomer group is really, really flush. Their balance sheets are in excellent shape, and they own their homes. You know, they're spending in a prudent way. So if we have to have a recession, we think that that the resilient consumer can make it mild, truly, and so far, that's looking good. And if I may say also, what's very unusual now is we look at the PMIs, we look at manufacturing and services, and we know that manufacturing has been in recession for a while now. The difference between services and manufacturing is stark, and that should close. And maybe it closes by manufacturing getting better.
Linda, let's talk about what's happening abroad. We did get the latest growth numbers out of China, coming in much weaker than expected. In the second quarter, we're talking about 0.8% growth. That led 3 banks today to cut their projections for China. We're talking about JPMorgan, Morgan Stanley, Citigroup. We're now looking at roughly a 5% annual growth rate. You say specifically there could be a potential tailwind coming from stimulus. I'm curious to see what you see specifically, because the expectation, at least among those who cover China, appears to be, yes, there could be stimulus, but not enough to keep the momentum going on growth.
Well, the momentum, I don't think that the momentum so much, and particularly in these last several months, has been for a very strong recovery in China. I think we've decided a few months ago that it won't be as strong as was expected, and then kind of the AI and the technology took the mantle of let's be bullish here on growth and on earnings in particular. But indeed, I'm not a particular expert on this. And in fact, any information I get about China crosses my desk can go both ways. The fact that the stimulus packages have been mild to what we would see seems to be more of a messaging that China wants to do. And definitely they have the wherewithal to do a stronger stimulus if they want, particularly concerned about the property sector there. So it may be milder than we expected, but we still may see some stimulus of a bigger impact coming down the road. And that could be yet another tailwind for global growth in the economy. And the energy patch, which I think you were talking about just before my segment here, that's had a tougher year this year. That's an area we think could have some value.
An area that we will watch. Linda Dissel, we have to leave it there. Federated Hermes, a senior equity strategist. Thanks. Well, markets posting slight gains as investors do await for a big batch of earnings this week and over the next several weeks. Jared Blickery has a closer look at some of the movement that we've seen since the start of the year.
Shauna, I was just looking at some of the record highs we can expect today and some of those that we've seen recently, and it's becoming a more diverse group. We talk a lot about concentration, and yes, there's going to be a Nasdaq 100 reshuffle, not going to really solve that. But here, let me just go over some of the names that we've seen accelerate over the last month. We have, for instance, ON, that's a semiconductor company, that's up 16%. Booking is in travel, that's up 12%. Pulte Group, that's home construction. DHI, another home construction. NVIDIA, we know that's a chip company. We're seeing some of the returns spread out here, which is good to see. Let me just show you what's happening in ETF worlds. XLI, so we have XLK. This is the S&P 500 Spider Technology Fund. Guess what? I'm going to show you a 3-year chart so you can see it is just peaking above the prior highs here. So we don't have any of the major indices at record highs, but guess what? The tech component of the S&P 500 is at a record high. Now I want to go to an unrelated field. This is home construction. We've seen that accelerate this year. Now that got to its record highs actually a few weeks ago. It has accelerated beyond that. And now here's another one. This is a subset of the technology group. This is semiconductors. You look at a chart of SOX, it's a little bit different, but SMH, the Van Eck offering of semiconductors, this is back up to its highs. Then you take a look at industrials. Guess what? A little bit different chart. It's at record highs. And then finally, value. So if you have tech and value also reaching, both of those reaching record highs right now, difficult to make that concentration argument that we were trying to make a month ago, 6 weeks ago.
It all changes. You just got to take it week by week when it comes to the markets here, Jared. All right, Jared Black-Reed, thanks so much for that. Well, we are coming up next. A warning for AI investors. The generative AI hype has Wall Street bullish, but our next guest says some of the AI stock plays have little room, if any, to run. We'll tell you which stocks he says to avoid and which he likes on the other side.
We are seeing stocks edging higher as the earnings season takes center stage, but with higher rates and inflation still top of mind, where should investors be putting their money? We have Mario Veneroso, Kingsview Asset Management Partner, here to break it all down for us. Mario, we're going to start with what you say investors should avoid. Tech stocks have had an impressive year thus far, but you're saying to avoid some big names in that space. NVIDIA at the top of that list, and I will tell you, that's increasingly becoming a popular one for staying away because of the valuation play. Walk me through your thesis.
Absolutely. Pleasure to be here. Thank you for having me. So to quote the late Wayne Gretzky, one of the greatest scorers of all time in hockey, they asked him, what makes you such a great scorer? And he said very simply, it's not where the puck has been, but where it's going that counts. And to me, seeing the first half of this year, NVIDIA up literally 200%, extremely extended. It's a trade right now I'd like to avoid, and I'll explain why. The Nasdaq is going to do a rebalance literally next Monday. And very frothy names like NVIDIA, like Microsoft, who have been over-concentrated within the queues, they're going to be cut and their positions are going to be slightly decreased. Now, this AI frenzy, I've been trading these markets for almost 15 years now. I want to give you an analogy of what it reminds me of. Number one, the 3D printing phase back in 2014, where they said 3D printing is going to change the world. Then from there, in 2018, it was the marijuana phrase, where MJ, the ETF, and all the marijuana stocks was also going to change the world. And recently, you can look at the Bitcoin momentum trade in 2020. Now, I'm not going to say that AI, there's no place in this world for it, because I do believe in it, and I'm a proponent of it. And I know NVIDIA is one of the major market players within that space. However, I'm all about fundamentals and earnings. And if you look at last year, in 2022 in March, NVIDIA did $8 billion in revenue. If you look at this March in 2023, they did $7 billion. So to have a stock go up over 200% on all the sizzle and no steak, I would avoid it right now, and technically too, because this is a momentum-based market, NVIDIA is extended. I think there's better plays, and like Wayne Gretzky said, it's not where I've been, it's where I'm going that counts, so I would be forward-looking, not backward with NVIDIA right now.
Well, Mario, when it comes to some of that valuation concerns, I guess, because you drew on some of the comparisons that we've seen to, a lot of people call some of those things like 3D printing a fad of the past. Do you see an investment opportunity within AI, just not a name like NVIDIA right now, given the valuation? Or is this a case, an investment thesis that you're making across the landscape?
It's not completely across the landscape, but you have to look at how bifurcated the market is. So I'll give you an example. One stock that I do own that's also a semiconductor is Avago, which has also done phenomenal, hitting literally a new 52-week high today. But the difference between a company like Avago and NVIDIA is valuation. And valuation matters when you manage money for clients. See, I can't buy the fact that something's in the stratosphere because to me it's just not diligent. I'm not going to chase money and chase returns. I'm going to take a sound fundamental approach to investing. So I do think there is areas that are less frothy that from a risk-adjusted standpoint may make a little bit more sense. But as a whole, I mean, the last 2 months, if you look at the overall sentiment of the market, it was as if AI cured cancer and creates rainbows and butterflies every day, which it hasn't as of yet.
Another name that you say to stay away from is Microsoft, obviously a stock that's gotten a lot of attention because of AI, but this is a bigger play. When you think about Microsoft, the company, they have their tentacles in so many different spaces. What don't you like about it?
So I think Microsoft's a great company, and I own it for clients, and indirectly I own it through the queues. However, the question is where to stay away from now, putting new money now. And again, if you look at Microsoft, it is extended. Right now, the valuation on the S&P is trading nearly at a 20 multiple. If you look at Microsoft, which is one of the biggest proponents in major ETFs within the market, it trades nearly double. And plus, with the recent announcement with Activision, I think it's going to take time for that to seep through the system. They do have a diverse business, but also, too, look at the rebalance starting next Monday. Microsoft is literally going to go from a 12.8% weighting within the Nasdaq to 9.8% weighting. So just with anything, if the overall major index is going to cut its position in Microsoft, I would follow that. And I think there's better plays out there that are not as extended. But between the two, I think Microsoft is 100% less extended than NVIDIA. But overall, it's still extended.
All right, Mario, let's talk about some of the names that you do like outside of that space. You like Toast right now, the software firm that's helping restaurants handle their payments. It's a stock that has certainly struggled since it went public just about 2 years ago. What's the catalyst do you see for Toast going forward?
So I like Toast because it was a recent IPO. It fell from grace. But the biggest thing about Toast is that they're literally, as of right now, one of the major market players in small to mid-sized restaurants. And that's a $600 billion industry. And it's a 10-20-30 rule. And I'll explain what that means. Right now, they have market share at 10% across the US. They have a 20% market share with major metropolitan cities such as New York. But here's the biggest thing, the 30% rule. They're looking to increase their revenue by 30% year over year for the next 3 years. And if anyone that is familiar with the platform, there are leaps and bounds other payment processors within the restaurant space. And if anything we learned from the pandemic is People like to socialize. They like to go out to eat, especially millennials. They prefer experiences over material things. And if you look at the chart on Toast, it's recently breaking out of a long-term base, a cup and handle, just broke resistance level at 23. Stock is up 3% today, trading around 26. Forward earnings look strong, and because of that, and they're one of the first gold miners in the pot of gold. I think if you add all those reasons, it makes a lot of sense to look at Toast.
Finally, very quickly here, Dow is the one that you really like. Walk me through what you like about the stock.
Absolutely. So, when one area zigs, another zags in the market. So I wanted to give you a growth play in Toast, but I want to give you a value play in Dow Chemical. Dow Chemical is a company that's been around for over 100 years. And they make ethylene, which is a major component, a chemical component in making plastics. They do over $50 billion a year in revenue. They literally trade at a 12 PE ratio. So it's literally almost half the price of the S&P. But Dow's more of a turnaround story with earnings, and it's down almost 1% today. Another reason why I like it is that it has a return of equity of 15%.
Mario, we're up against a hard break here.
No problem.
I apologize, but you got your case in there. Kingsview Asset Management.
Fair enough.
Mario Veneroso, good to talk to you today.
All right, that's a closing bell on Wall Street. This market check sponsored by Tasty Trade. All three of the major averages starting the week here, ending with gains. The Nasdaq up just about 1%. The S&P well above 4,500 here, and the Dow up just about 76 points. Let's take a look at some of the individual movers of the day. The trending tickers. Our very own Alexandra Canal is here to help us break it all down. And guys, let's start with Ford. Ford under pressure all day after announcing price cuts to the Ford F-150 Lightning, their EV pickup that we know, at least initially, was saw some pretty strong demand. But Ali, when you take into account what they are doing here, they're joining the price wars that seem to be developing here within the EV space. Ford cutting the price of the F-150 Lightning by up to $10,000. So certainly some concern here reflected as we're looking at the stock move. But the cheapest version is still more expensive than it was when Ford initially debuted the F-150.
Still more expensive, but these cost cuts are pretty significant. And I do think the conversation in the back half of 2023 is how this price war, not only in the US, but also in China, is going to impact the margins of all of these companies. Tesla is another big EV company we talk about a lot on this show. Those earnings coming up later this week. And on the heels of this Ford news, we got the news that they are finally in production of their Cybertruck. They're another company that's been in the pricing wars. So I feel like all of these EV makers are going to really have to reassess their pricing, especially as EV adoption becomes more and more popular.
Yeah, and we're talking specifically about EV trucks, and that's becoming increasingly a crowded space. Yes, the price cuts did affect the stock, but Ali, to your point, it also collided with that news that came out of Tesla. Not entirely a surprise, because we were expecting some kind of delivery event to happen later in the year. But now, as Pras pointed out earlier, we know they're likely to compete in a similar price point as the Ford F-150 Lightning. So that's going to set up an interesting competition, particularly in the EV truck space at a time when we're still asking, how significant is that demand going to be, and what are drivers willing to shell out in that space? We're also watching shares of Palantir today. Mizuho out with an optimistic note on the company raising its price target, saying it is well positioned for the AI wave, but did leave its rating at neutral. And guys, AI wave, yes, that is the magical word, but Palantir really is one of those companies that is competing in that space. It is all about data for this company. No real surprise on that front that Mizuho sees a lot of optimism on the back end of that.
Yeah, the AI wave. Certainly all of these companies are benefiting from it. And it's interesting to think that Palantir was once a meme stock. Remember that back in the day? But again, I do think it's important that there was no upgrade to this stock. Still neutral. That being said, a pretty significant price target boost, $14 a share, up from the prior $8 a share, suggesting more upside here. But I do think analysts across the board are split. According to Bloomberg data, we have 8 sells, 7 holds, 3 buys on this stock. And the analysts also saying that it's a bit too early to really know the impact of AI. And I think that's a story across the board here. AI is so new for a lot of these tech companies, these tech giants. How will they implement AI, and how will they deploy the new technology is going to be important.
Yeah, exactly. And exactly the impact on their bottom lines. I think that's a big question out there for investors, for analysts at this point. And Ali, to your point there, the fact that they did not upgrade this stock, they stopped short of turning bullish on it. They were pointing to some of those valuation, concerns, but just the fact that the stock has nearly doubled in just the last 6 weeks, ever since Palantir did disclose in that last earnings call their push into AI, and how exactly as some of those AI tools, they see it better enhancing their business. So another stock here that has certainly run up after the mention of AI, but I think the pressure on now for these companies, like a name like Palantir, is what exactly it is going to turn into in terms of results here in the coming quarters.
And we're seeing a lot of overheated stocks in that tech sector as well. We're also watching telecom stocks under pressure today after AT&T was hit with yet another downgrade. And this story is crazy about the lead that was found in some of these cable cords, which is from the Wall Street Journal, did a whole investigative report on this. And there's quite a few risks here that a lot of these analysts are pointing to when it comes to legal action. How do we even resolve these lead cables? And we have JPMorgan, Goldman Sachs really coming out here and saying that this was not known to the market. Therefore, it's having this material impact on the stock price right now. That being said, though, I still think there are more questions than answers when it comes to the future of how to even resolve this. But we're looking at some serious lows, in some cases 30-year lows here for these telecommunication giants.
Yeah, we saw that in AT&T stock right now. And Citi, to your point there, Ali, saying that they expect this to remain an overhang for this stock like AT&T and its valuation for at least a few months, but potentially longer here, because a lot of unknowns just exactly how long this is going to be and how big of a financial risk this is to AT&T. Verizon is another name too, Akiko, that's under pressure. They were downgraded to hold from buy at Edward Jones, who also cited those lead issues. So analysts kind of reassessing what the true valuations are for these stocks, at least today, given this financial risk that they're now seeing because of the lead issues.
Yeah, I mean, worth really noting what this Wall Street Journal investigation reveals. It's not just about lending the cables. It is about the company knowingly continuing forward with that they knew the blood levels were very high, contained high levels of lead all the way back to the 60s and 70s. So to your point, Ali, I mean, this is a huge overhang, but also what is that next step? It feels like one of those stories that we have seen from other companies where it will continue on for years and years and years, could be a huge hit financially for AT&T, which is why we are seeing that stock take such a dive, and other companies in the space take a dive as well, because nobody really knows what this means in terms of lawsuits, other financial ramifications that could come as a result of this Wall Street Journal investigation. All right, Ali, thanks so much for joining in on that. We're going to see you a little later in the show. Bank earnings season in full swing. Some of the big banks already reporting, and now the focus will shift to the regionals starting tomorrow. Joining us now, a look at what to expect, is David Chiaverini, Wedbush Securities Managing Director. David, we'll talk about the regionals just a bit, but I'm curious to get your headline take so far from what we have heard from the big banks.
Yeah, so far, what we heard from them wasn't too entirely surprising, although what was interesting in terms of a read-through for the regional banks and the mid-cap banks is JPMorgan, when they were talking about credit quality, they mentioned they were seeing some incremental weakness in middle market commercial. And that is kind of a bread and butter type of business for the mid caps and the regionals. In terms of deposit flows, no big surprises there, a little bit higher for JPM, a little bit lower for Wells Fargo. But what really took investors by surprise were the results from State Street, ticker STT. So their non-interest bearing deposit mix shift was much larger than what some investors were expecting, and the stock really took it on the chin on Friday when they lowered their NII guidance to down 12 to 18% sequentially in the third quarter. So the big bank earnings weren't entirely comforting for the mid-cap banks, but the silver lining is that JPMorgan and Wells both did increase their net interest income guides for the year. Now, JPMorgan did also say not to expect this higher level of $87 billion to continue. They're cautioning that the run rate could go back towards the mid-70s. So a little bit of good, a little bit of bad, but it will be interesting to see how the regionals play out this week.
Well, David, how do you expect the regionals to play out? Because clearly the group has been under a tremendous amount of pressure ever since the stress started to emerge within the sector back in March. We did get a little bit, I guess, reports in terms of the fact that they were on stronger footing, some of them, in the last round of results. What do you think we'll hear this time around?
Yeah, so unfortunately, I do think that the net interest income revisions are going to be guided lower for the mid cap. So even though the big banks did see their NII guides go up, I think that the deposit pressures and the mix shift from non-interest bearing to interest bearing deposits is going to be too much to handle for the banks, at least in this earnings season. Now, the hope is that, when they reset guidance lower this earnings season, that it will be more achievable and attainable, and that the downward revisions kind of subside with this earnings release. But that's the main thing we'll be keeping an eye on, as well as funding costs overall. I think credit quality will still be excellent in this quarter, but we'll be keeping an eye on to see if there's any early signs of cracks.
What about the big question around potential regulation?
Yeah, no, excellent question. Regulatory capital requirements, that is the big open-ended question. For the big banks, it's pretty clear that we're going to see roughly a 20% increase in capital requirements for the likes of JPMorgan and Wells Fargo. What the chatter is that that's going to apply only to the biggest banks. Now, in terms of other regulatory impacts, the line in the sand is likely to be around 100 billion. What some people are talking about is potentially the accumulated other comprehensive income, AOCI, so the mark-to-market losses on securities portfolios, that could be included now as a hit to capital as opposed to being excluded from capital. So we'll find out the Basel III endgame rules pretty much any day now, and could be upwards of another month or so.
David, when it comes to credit quality and the deterioration that we are seeing in commercial real estate right now, how manageable will some of the exposure to the office sector be in terms of the banks that are at the most risk within the regionals?
Yeah, so the good news is that this should play out over time. So the banks still are in a positive profitability position. So given that the average life of these loans is over multiple years, so only a fraction of the outstandings are coming due each year, they should be able to manage any potential hits and loan losses related to it. Now, will the losses be there? Yes. Are banks setting aside additional reserves? Yes, they are. But we don't think it's going to be a one-quarter event in which if it were to all happen in one quarter, then sure, the banks would take a big hit to their capital in that quarter. But given their profitability, it should be manageable over time.
So not a one-quarter event, but which bank is most exposed to the commercial real estate sector?
Yeah, so there's a few ways. There's a few ways to measure it, but for the regional banks, Comerica is at the upper end of the spectrum, as well as M&T Bank are at the upper end of the spectrum as well.
Wedbush's David Chiaverini, good to talk to you today. I really appreciate the time.
Thank you.
Coming up, Microsoft and Activision Blizzard overcoming yet another hurdle on its path to becoming the largest ever gaming deal. We're going to discuss the duo's latest win on the other side of the break.
Microsoft racking up another win ahead of tomorrow's deadline to close its Activision Blizzard deal. The tech giant granted a 2-month pause of its appeal in the UK. Alexis Keenan is here with the details. And I think, Alexis, everyone's asking just what this means ahead of tomorrow's deadline.
Yeah, we're wondering, and we keep asking both Microsoft and Activision, saying, what are you going to do? They haven't said. So we can speculate a little bit. They have that July 18th deadline. That's tomorrow. Feasible, maybe, but it would be so difficult to do. The legal experts I've been talking with said parties will probably agree to some type of modification of that deadline because it does come with a $3 billion breakup fee. But the parties don't want that here, right? They want this thing to go through. So the expectation is that there'll be some sort of modification, some sort of waiver of that fee so that the parties can keep negotiating. On top of it, we're just learning from Reuters today, this afternoon, that the UK has had its court pause the previous decision of the UK's regulator to block this deal, saying that they will take some additional possible considerations under advisement. And maybe, just maybe, Microsoft can find a way to appease the regulators there. That, of course, you called it hurdles, right? On top of it, Microsoft got through another hurdle on Sunday when the company agreed to make more concessions, making the game Call of Duty, the big game that they're after here with Activision, available on Sony's PlayStation for 10 years.
Yeah, question is whether or not that's going to satisfy the regulators. We're going to have to wait and see. All right, Alexis Keenan, thanks. A dark cloud hanging over Hollywood as writers and actors are simultaneously on strike for the first time since 1960. Both unions and studios are deeply split on streaming compensation and the threats to come from technology, including AI. But how costly will this disagreement be for the industry? Here to break it all down is Yahoo Finance's Alexandra Canal. And Ali, how costly could this be?
Well, a heck of a lot, Shauna, and a lot is at stake too. Moody's had a new report out earlier today estimating the projected cost of what the current Director Guild contract, along with the eventual contracts with both the actors and writers, could cost these media companies. And Moody's estimates that it's anywhere between $450 million to $600 million more each year. Moody's also laid out the sectors of the industry most exposed to a prolonged strike, saying movie theater companies are most at risk due to their reliance on new content. Also at risk are diversified media companies transitioning to streaming from linear TV, given those secular declines that we've seen. But streaming-facing companies, those platforms with limited to no exposure to linear declines, they remain best positioned, along with those media companies that have a more global overseas presence and strong balance sheets. Moody's called out a slew of companies that are best positioned to weather this storm, including Netflix, Comcast, Fox, Sony Group, along with some of those newer participants like Apple and Amazon. But guys, this is something that is likely going to continue, and Moody's said that this will likely be a very long strike. And currently there's no end in sight. The writers' strike is in its 3rd month. We just saw the actor strike happen at the end of last week. You know, you have to wonder when we can finally reach an agreement here.
So Ali, you know, that divide that you talked about between the tech companies and then sort of the pure play, you know, studios like a Paramount, it's an interesting one because we've heard, for example, in the field about, you know, is there a divide that could emerge here? Could there be a deal made with somebody like a Paramount, maybe even a Warner Media, those who have been on the studio side, but Netflix, Apple, Amazon continuing to be holdouts?
That's a possibility because Netflix, they're not going to be the first company to cave, right? They're a profitable business right now. They have a lot of content at their disposal. They could be okay with a strike that lasts for a while, whereas, like you said, a Paramount, for example, that has CBS as a network, they can't really survive a strike that is super long. We've heard that if the actors' strike goes past September 1st, that creates even more headwinds for this ecosystem overall. So, I mean, maybe I would be surprised. I think they're going to try and band together, but that's certainly a possibility considering this huge divide and those companies that are most and least at risk moving forward.
Finally, Ali, I'm putting you on the spot a bit, but I'm curious to get your thoughts on what we heard from Barry Diller over the weekend. He made some headlines saying essentially, look, if this continues in its current form, this could lead to a collapse of this industry. He also suggested a September 1st deadline, but also that, look, everybody is paid really well at the top. So the executives take a 25% cut, the top paid actors take a 25% cut.
Yeah,
what are the chances?
I mean, I don't think the top paid actors are going to want to do that, but that was his suggestion, right? I mean, those that are paid well, you're going to have to sacrifice for those lower paying actors. I mean, if you have a Meryl Streep coming in there and saying that she'll take a pay cut, I'm sure actors would champion that. But I just don't know if that's what we're going to see. I think, the pessimist inside me thinks that people are a little greedy at heart. So I think there needs to be a broad establishment of these streaming compensation, of these how you pay people at the end of the day. So I'm not quite sure if I think that what his suggestion is going to play out, but you never know. I mean, September 1st is right around the corner though. So, I mean, you only got a month here, and I doubt we're going to get any deal by that point.
Yeah, that seems like a very ambitious timeline. Right before the Emmys, though, right?
True. I guess if you want to have that award show on, the show must go on, as they say.
Well, 25% pay cut, that would certainly narrow the gap.
Yeah.
Pretty substantially, but I agree with you. I don't know if exactly the actors and executives are going to be on board with that big of a cut. All right, Allie, thanks so much. Let's do a check of the markets here, sponsored by TC Trade. All three of the major averages ending the day in the green. Technology, financials, the outperformers on a sector basis. You're looking at the Nasdaq closing up nearly 1%. The S&P up about 0.4%. All right, coming up, our Yahoo Finance team is diving into some of today's top trending stories. Josh Schaefer is standing by with what's on deck. Josh.
Yeah, Shauna, we've been talking a lot about that writer strike and how companies might have to adapt. Well, up next, we're going to talk about how one of America's favorite reality TV shows is going to be changing to come up with some new content, and it might even include your grandparents. We'll have the details about that next.
No change. The Federal Reserve holding rates steady in the current range of 5 to 5.25%, but raising interest rate projections to a new peak of 5.6%, implying at least one more rate hike from here.
I think this is very hawkish. I mean, the idea that the dot plots have moved up to include about 2 more rate hikes coming from the Fed. I think now you're going to start to see markets maybe projecting maybe 50 basis points at the July meeting to get us there. I don't think they need to keep raising rates. I think they should be done.
The Fed is sending a little bit of a hawkish pause here, and in that sense, I think it confirms the market's expectation. I think the key here is what does Chairman Powell say from the podium?
If this is in fact a hawkish pause, we would expect to see potentially a stronger dollar along with yields going up, and that's what's been happening here. We're still waiting for Powell to take the podium, and that's really when we see the fireworks.
Fed Chair Powell saying that the Fed has not made enough progress on inflation. It needs to come decisively lower, and that's why the committee sees 50 basis points more of rate hikes here.
I didn't anticipate that the Fed would come out and do something different because they don't want to cause that extra volatility in the markets. However, at the press conference, I don't think we got a very clear answer as to what the goal was going forward.
It seemed to mainly be about a couple of things for me. One, slowing the pace. He said that a bunch of times. And then the other thing is to hold the threat of rate hikes over the market for longer. Putting 2 hikes in the baseline essentially takes us through year end at this new slower pace.
Most FOMC members, each dot represents a member here. They see interest rates peaking at 5.6% this year. Now that's higher from the March projection of 5.1%. So that does suggest that the Fed is going to raise rates 2 more times by 25 basis points, or perhaps 1 time by just 50 basis points here. Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined as always by Praz Subramanian and Josh Schaefer. We're digging into a lot of top stories today. And Praz, I know you have your eye on Tesla.
Over the weekend, we finally saw something from Giga Austin, the first Cybertruck rolling off the, it said they were built, it was built in Giga Austin, maybe not coming off the assembly line, but the first Cybertruck there shown this weekend on Saturday. So big news there, stock charging higher here, because the company is seemingly slated to kind of go into production of this truck later this quarter, limited quantities, and hold that potential customer delivery event at the end of the quarter that Musk was talking about. So big news there for them. We'll see if this car that came off the line was actually just a pre-verification build, which is something that just goes through the line, see if it comes out okay. They won't sell it to customers, perhaps. We'll see. Still good news.
Interesting to look at just tracking estimates, right? And we love talking about Wall Street estimates and what these different analysts are putting out there. There are 3 analysts compiled by Bloomberg already that have expectations for sales of the Cybertruck in 2023. The average, the consensus of that is over 3,000 sales of the Cybertruck in 2023. It is July. So I'm just curious what we actually see come Q3, Q4. Those projections are for 70,000 Cybertrucks to be sold in 2024. So this is a legitimate part of the Tesla growth story now and where the company is headed for them to start selling these trucks. So it'll be interesting to see when we do start. It's good that they're being built. It's good that they're being built, but it's going to be interesting to see when we start seeing them actually be sold, delivered. How much does the truck even cost? We don't even know.
That was my question. So we don't know how much the truck costs. We obviously got the news from Ford that they're dramatically slashing their costs. I feel like this is a story that's happening in the US, China, these pricing wars. How do you think Tesla will approach the price of this thing and how it stacks up to some of their other vehicles?
So today, apparently, I saw the tweet. Musk had replied to a tweet about those Ford cuts and said, the Lightning is a good truck, but it's too expensive. And some people took that as an indication that the Cybertruck will come in at a mid-level around the pricing of like the mid-range F-150, maybe around 65 grand or so. So be competitive with the Lightning, but not be crazy expensive. So that was taken as good news. Tesla stock up, Ford stock down, but we have no confirmation of that. You know, I spoke to Motor Trend's CEO a while back, and he said Tesla will be lucky to get that under 75,000. So a range of sort of outputs here or numbers here for what
I wonder how much the pricing more even matters here. When you talk about, is it the same consumer? Is the same person buying the Tesla Cybertruck that's buying the electric F-150 I don't know, right? Because it's probably not the person that drives the normal F-150 that's buying the Tesla Cybertruck.
When I said yes, I was agreeing with you.
Yeah.
I think that they're two different buyers. Like the Rivian buyer is not a work truck buyer, right?
Right.
It's an electric adventure vehicle, going out in the wild, going camping. It's not about going to the job site, right? So I think there's two different buyers there, two different sort of use cases there, and Tesla could still sell a lot of the Cybertruck to these owners.
Yeah, and Tesla reports earnings this week. Do you think the margin story is going to be the top story here to look out for Tesla, especially amid all these price changes that we're seeing across the sector?
I think it is a major point there. A lot of analysts are saying that this might be the trough, the gross margin trough for Tesla. Sink below 20%, and maybe it'll pop back up in Q3 or Q4. That's what the thinking is. They already cut the prices. You've taken the hit there. Now it's time to sort of enjoy those economies of scale, sell those cars, enjoy those EV tax credits, at least here in this country, and try to get back above 20%. I think that's the kind of like.
So well right now. You wonder. If
I mean.
When is the shoe going to drop?
No, people are talking about, oh, well, the stock has run up too much. Elon Musk needs to answer these questions about profitability. I'm like, the stock never trades on fundamentals. So what are we talking about?
Yeah, that's a fair point. That's a fair point.
Yeah.
Well, I don't know if you buy a Cybertruck for $100,000, but some people are buying Lionel Messi tickets for $100,000. The story I've been watching here, Lionel Messi joining Inter Miami officially yesterday. This is the introduction that was broadcast live, we should mention, on Apple TV Plus. We know they don't do a lot of live events, so interesting to just see them do live streaming. Also interesting to see how crowded that stadium was. There was a 2-hour rain delay before this event. It was pouring in Florida. 2-hour rain delay. He still fills a stadium. CNN was out reporting that some of the tickets for this Friday's game were as high as $110,000. I checked a little bit earlier this afternoon. The highest ticket is about $55,000. Get-in price $230, which is significantly higher than you normally pay for an MLS game. So it seems like you're starting to see the impact here and wondering what it means for Apple in terms of subscriptions, in terms of this big MLS deal. Remember, they're paying MLS $250 million a year. Those broadcast rights are $250 million a year for professional soccer that otherwise I think a lot of people sort of think of as an afterthought here in the US. So interesting to see this interest pick up even more.
Yeah, definitely, I think a positive for Apple. And like you were saying, to me, professional soccer, it's not huge in the US. It's all about the NFL, MLB. Soccer, huge abroad, not necessarily in the US. So I am curious if this kind of piques more interest in the sport overall and what ripple effect that could have.
So it's a couple of things, right? $110,000, that seems insane to me. I don't know where that's coming from.
It's some fancy, sweet ticket,
yeah,
right?
I heard $487-ish average ticket, or a normal price for that League Cup game with that Mexican team there. But I think they picked the right spot in Miami. It is a huge soccer hotbed.
So true.
Latin America, the kind of the gateway to Latin America. The perfect spot for Messi. Plenty of South Americans there. I could see the hoopla. I could see the hype. If he landed in like Kansas City, it's not going to happen, right? So I can understand that, but I think right about that big TV contract. Is Messi going to be able to justify sort of that cost that Apple paid? I know he's getting a piece of that. It's such a complicated deal, right?
I think it gets into an interesting part too. You mentioned it being the right market for it. There's an interesting article in the Journal today by Roshan Fernandez pointing out how many Argentinians are in that area. Over 50,000 Argentinians in that metro area there when you go all the way to Fort Lauderdale as well and kind of combine those big Florida areas. But so you have a lot of people there.
Wow.
And then also, Press, I'm curious what it does for international sales for Apple. Think about the icon that Messi is and the fact that people from Argentina are going to want to watch him play no matter where he's playing, no matter the quality, no matter if you can argue that the MLS isn't that great and he's going to dominate. People adore the guy. So I think you're going to see maybe some international boost as well, which would be interesting.
And that's a really big deal when it comes to all of these streaming giants. It's something that Netflix has been able to really harness very well, those foreign subscriptions and more localized content overseas. So you wonder if the other streamers, if they can get into that, that's a good thing. But guys, maybe you're not into watching sports. Maybe you'd rather watch reality TV. And there's a new iteration of the long-storied Bachelor franchise. Here's a sneak peek.
He posts his thirst traps in a leather-bound album. His DMs have postage. He gets the early bird special anytime he wants. If you call him, he'll answer the phone. He doesn't have gray hair. He has wisdom highlights. Florida wants to retire and move to him. He's Gary.
And I'm your first Golden Bachelor.
There we go. The much anticipated Golden Bachelor making their debut. Now, the golden here is the golden years. That is what they're referring to. The women that will be featured on this show above the age of 65, so a more mature audience. It will be exactly like your normal Bachelor. So he'll be handing out roses at the end of the day. But I think for ABC, it's interesting timing here, considering we have the writer's strike, a lot of that scripted content, no more. You're going to see a lot more reality TV, a lot more game shows. And now you have a brand new spinoff of The Bachelor.
I'm going to be fascinated to see what the viewership is after the first 2 weeks of this. I think there's a serious novel aspect that really intrigues you. And then you wonder, like, don't you love reality TV for the fights, realistically, right? Like, it's fiery,
I can see some grannies getting in on it.
Fiery young people
over
that are just ridiculous. And like, I guess The Bachelor has gone too far, maybe. Some people argue now in that way where people only want to go on the show to be famous.
Yes.
So maybe this removes that part of it. But you also love the drama. And I just wonder if people over 65 are going to be fighting the way that some of the other people do.
So I saw that the last, the season finale of the last year's Bachelor was the highest ever rated show that they had, right? 2.39 rating or whatever the hell it was. That was in March. Who watches linear TV? It's older people.
Yeah.
Who's going to want to watch this show? I think it's a great kind of pairing of reality. There's no writers. The Bachelor franchise is huge. And then you're tapping into that over 65 market that's really into TV. Great. Maybe 2 weeks from now, or maybe 2 weeks into the season, might have a dip, but I feel like I'll watch that premiere.
Yeah, I will too. And like you were saying about some people going on the show for the wrong reasons. And if you watch The Bachelor, that's one of the words they always say. Yeah. I mean, I don't think any 65, 70-year-old is going on the show for clout or for Instagram followers. Maybe, you never know.
If they're savvy, they will, right? You make money off that. You go, you get famous, you get brand deals.
If this will be a new influencer, an older influencer perhaps, that will emerge
from
a
grandmas
show like
of TikTok take Bachelor.
I mean, I think we're like maybe not giving them enough credit. Maybe they are doing that. Say, hey, I want to get a deal on arthritis cream. You know, like.
True. Yeah, I guess that's the case. I mean, well, personally, I'm going to be rewatching that trailer over and over again. But for you guys, there's more Yahoo Finance on the other side of this break. Stay tuned.
Marriott and MGM Resorts are betting big on hospitality and entertainment. The pair has announced an exclusive long-term licensing agreement that takes aim at attracting consumers to stay at MGM properties across the Vegas Strip. The creation is being dubbed MGM Collection with Marriott Bonvoy, and it begins in October. Joining us now is Marriott CEO Anthony Capuano and MGM Resorts CEO Bill Hornbuckle. Good to see you both here. Anthony, let me start with you, or maybe I should say this is a jump ball. How did this deal come about? Because I view corporate America, a lot of big companies like both of your companies have these really big rewards programs now, and nobody's communicating. So maybe you could educate your fellow leaders across corporate America, and how'd you make this one happen?
Well, the good news is we didn't need to start from a dead stop. When Bill's company acquired the Cosmopolitan here in Las Vegas, Cosmopolitan was already a member of the Autograph Collection. So we've had about a year to work together, hopefully to demonstrate to MGM the power of the Bonvoy program, the power of the company's revenue engines. And I think that gave us a platform to start talking about whether plugging in the entirety of the portfolio here in the US might be able to drive more power, more synergies with our 182 million members and Bill's 40 million loyalty members.
And maybe just to pile on, when we looked at it in context, obviously we've had longstanding relationships. You just said it. We have Avis. We had Hyatt. We're coming out of Hyatt going this. But when we acquired the Cosmopolitan, and we looked ultimately at the value that was been driven and the kind of customers that were coming, and then we understood the scale and scope of 180 million members, for us, it was pretty obvious. So the teams have worked collectively for a while, because obviously it's complicated and the scale is significant to both of us. And so we're at a point, though, we thought today would be a great day for announcement on a program we're going to roll out this fall.
Bill, within that 1 year of working together with Marriott, being in that universe, are those customers spending more, and where are they spending more inside of your properties?
I think the answer generally is yes. The Cosmopolitan sits in obviously a pretty unique place in terms of its demographic and its profile. Generally millennials. A lot of the customers that came were on rewards programs, so obviously their rooms arguably were taken care of, and so their pocketbook is a little larger to enjoy other things, entertainment, dining, and some of the great offerings we have not only there, but across our portfolio here in Las Vegas. And so we're pretty excited and pretty motivated by what we saw, to the extent, obviously, we've reached the deal that we have.
Anthony, why is this deal important for Marriott?
Well, it's important on a number of fronts. Number one, you and I have talked about this before, back when I was leading our development efforts. Our development strategy is pretty straightforward. We want to make sure we plant our flags everywhere our customers want to go for every trip purpose. And while we've loved the partnership on Cosmopolitan, this is the largest lodging market in the country, and we felt like we were underrepresented here. So now to have 12 extraordinary resorts within a 1.5 mile radius, we think it offers a really compelling proposition for our guests and our Bonvoy members. I think number two, when we think about growth, this increases our global footprint by 2.4%. So it's a great shot in the arm for our growth story. And number three, Bill touched on it, loyalty. Bonvoy is a really powerful driver for everything we do. Our Bonvoy members are going to love not only the resorts, but think about all the content that MGM controls and drives. Sports, entertainment, culinary, and more what our guests want are experiences. And MGM has really rich content.
And then from our side, when you can have exposure to 180 million Bonvoy members, and much like Marriott, if you think about it, we have Bellagio at the Ritz-Carlton level. Behind me, you see New York. And so our ability to take depth and really stretch it across both of our portfolios and have an offering not just for folks who are interested in the Cosmopolitan, but I think everything Las Vegas has to offer, and then combine it, obviously, with what we do here in Las Vegas, put some real excitement and pizzazz to the idea of coming here and the experience it can provide, again, was just overly compelling to both of us, I think.
Bill, help me understand this. So I am a Marriott Bonvoy member. I have been for a while. So will I get, because if I book a property with MGM, do I get a free steak because I'm a special tier? I mean, what type of perks will I be getting?
Look, we'll come out more details come this fall. You'll get a whole lot of that. But the idea is exactly that, where if you're a certain elevated tier, you'll have the opportunity to get certain access, i.e. perks, upgrades, events, Obviously, Bonvoy will market into our company, and we in turn market to Bonvoy customers in terms of special events. I mean, just think about the upcoming events. You got Formula One, you got Super Bowl, you got Beyonce here next month. What happens here is pretty special, and you as a Bonvoy member will have access to that.
Wait, Bill, does this get me Beyonce tickets?
Give me a call, bro.
Fair enough.
You get in line right behind me.
No, fair enough.
At least you didn't ask for F1 tickets. I think I can handle that easier.
Okay, we'll take that offline. Anthony, I'll put this question to both of you because I was thinking before coming into this, you know who doesn't have this program and who's probably not going to do it? It's Airbnb and companies like it trying to share homes on vacations. Is this one way to keep a competitor like that at bay?
Well, again, you and I have talked about home sharing a lot. We focus on our members, and we're deeply engaged with those members. We talk to them every day. We know what they want. And what they want with increasing frequency is unique, curated experiences. And on the long list of attributes that made this deal so attractive to Marriott, it's that rich content. It's these unique, curated experiences. And you could come here once a month, every month as a Bonvoy member and have new experiences. I forget the number, but hundreds of restaurants that you could experience. Yeah, almost 500 restaurants. The greatest entertainers in the world cycling through these incredible venues, world-class sporting events. And so the ability to offer those unique, curated experiences to our members, we think offers a set of really compelling experiences that nobody else can offer.
And then, Brian, we touched on it pre-recording, but the whole market MICE segment here in the context of convention, we have over 4.3 million square feet of space here in Las Vegas. It's about 20% of our market mix, particularly in hotels like Mandalay, Aria, where we sit today. A big component of our business. And obviously, Marriott's got a little exposure and experience in that space. And so partnering our two teams together is pretty exciting for us.
Bill, does this apply to any locations you have outside of Las Vegas?
Yes, it's for all of our 17 properties.
Do you think this will help?
5 resorts outside of Las Vegas across the U.S.
Do you think this helps the competitive position for an MGM?
Absolutely. Yeah, look, I mean, we have the good fortune of running in the low 90s year round. It's really about yield. It's about customer. It's about engagement and experience, and ultimately leveraging up on all of that experience and that yield. And so, but the answer is absolutely it does.
It's rare that we get CEOs of your caliber both on the same interview, and you're both global companies. And I'm really interested in, to the extent you could share things on China. We just got a very disappointing China GDP number. Anthony, let me go to you. What are you seeing in that country right now?
So it's interesting. China was one of the slowest markets to recover for our business because of the zero COVID policy. With that said, when we look at the April data, in mainland China, RevPAR was fully recovered to pre-pandemic levels. And in greater China, inclusive of markets like Hong Kong and Macau, we were within just a couple percentage points of pre-pandemic RevPAR levels. So we continue to see strong recovery trends across greater China. The one caveat I would give you is at the end of April, international airlift capacity was only about 40% recovered to pre-pandemic levels. So while we're encouraged by the pace of recovery, that recovery is almost exclusively domestic demand driven. And so our hope and our expectation is now that the borders open, as airline capacity returns, you'll see more and more of that recovery fueled by cross-border travel.
And for us, it's kind of a tale of two stories. If you think about Las Vegas, China has not really returned here in any meaningful way. Other side of the coin, we have 2 properties that presumably in Macau. They're booming. June numbers come out, they get published. We continue to hold excessive share. The market's booming. It's going to be over $20 billion this year. And so we're excited by what's happening there. To the extent there's a slowdown in that lens, we certainly haven't seen it yet.
And Bill, last one to you here. Las Vegas Strip, given all the data we have seen recently, has continued to come back, notably the convention business. Anything you could share on bookings for the back half of the year? Do you think the strength will be maintained?
I do, absolutely. Look, in terms of the convention, obviously we have a clear window into that, and so I think that's there and strong. And even if you look at about leisure bookings and you look into the future, Las Vegas has been the beneficiary. We have over 120% airlift into this market than we had in 2019. And so we're the beneficiary of that, and our portfolio sits right in the midst of it. So we're excited by what we see going forward.
All right, we'll leave it there. Good luck with this partnership. I'm a little disappointed I can't get Beyonce tickets, but I will maybe take you up on that Formula One stuff, guys.
All right, thanks, Brian.
Thanks, Brian.
Appreciate it. All right, Marriott CEO Anthony Capuano and MGM Resorts CEO Bill Hornbuckle. Thanks so much.
I always tell people that they should be maxing out their 401ks. And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%.
There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before.
There's two ways to really build significant wealth. One is through real estate, great investment, you get some tax advantages. Stocks are the other way. For most people, that's going to be the most viable way.
First, you've got to have savings. Second thing you want to do is really maximize your employer plan. You want to make sure you're getting the full match before you do anything else.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Ford is following in Tesla's footsteps and cutting prices. The car maker is lowering the price on the F-150 Lightning, slashing between $6,000 to $10,000. The company citing improving access to raw materials is one of the reasons for that price cut, but there are also concerns that demand is weakening, with some dealers warning of higher inventories on their lots. Meantime, Tesla directors are settling a compensation lawsuit with a $735 million payout back to the company. The board, which includes Larry Ellison, settling those claims they overpaid themselves. This marks one of the largest shareholder settlements of its kind, but it doesn't include Elon Musk's compensation package. That's the focus of a separate lawsuit that went to trial last year. The Food and Drug Administration has approved an RSV vaccine from Sanofi and AstraZeneca. It's the first vaccine that can be used on all infants and toddlers, whether they're healthy or have a medical condition. RSV is a leading cause of hospitalization among babies in the U.S. The next step in the process, the CDC's independent panel will meet in August to make recommendations on how the vaccine should be administered.
Time now to take a look at what we are watching for tomorrow. Well, investors are gearing up for another round of bank earnings. Bank of America and Morgan Stanley set to report their quarterly results tomorrow before the opening bell as investors look for more clues on the health of the consumer and the broader economy. JPMorgan, Wells Fargo, and Citi kicked off big bank earnings last week, surprising to the upside. Tuesday, July 18th is the deadline for the $69 billion merger of Microsoft and Activision. Reuters reporting today that Microsoft's appeal against Britain's block on the takeover was formally paused by a London tribunal, giving the parties more time. This comes following news over the weekend that Microsoft struck a deal with Sony to ensure Activision's Call of Duty franchise will remain on Sony's PlayStation platform for a decade. And shifting to the economic picture, a couple of prints that we are keeping a close eye on. We're going to get a better look at the health of the consumer with a fresh batch of retail sales data. Economists expecting a rise of 0.5 percentage point for the month of June. And then turning to housing, we will get the latest reading on homebuilder confidence. The index moved into positive territory for the first time last month in 11 months. Well, that does it for us today on Yahoo Finance. We'll see you right back here again tomorrow. Have a great day.